All right, welcome back. Well, with the stock market rising and falling, it can be really nerve-wracking and you might want to check on your investments. And if you're investing through your company's 401k program, your options may be limited. Now, Marshall Clay from the Welch Group is here to help us make sense of our 401k options. Thanks for being with us.
Thank you.
So we were just talking, and I will say I asked the broad question of what do you typically recommend in terms of investing 401ks? And you say it just depends, right?
You're exactly right. And I think everybody has a different plan, and a lot of plans have multiple options, and so they can oftentimes be confusing. And as we mentioned, they're limited.
Yes.
Right. So I try to break it down in three simple steps. And the first step is just asset allocation, right? So you want to try to figure out what your stock to bond ratio needs to be, and you really back into that based on how much money you have currently, and then based on what your goals are as far as how much money you need to spend. And the way I back into that is you look at how much money you need from the portfolio on an annual basis.
Okay.
Divide that between 3 and 4%, and that gets you your number. Now you have to factor in inflation and things like that, but you can back into how much stock allocation you need and how much bond allocation you need through that process.
And you recommend about estimating a 2% inflation rate?
Yeah, I would say somewhere between 2 and 3. I mean, inflation
right now
is a big topic of discussion, but
right.
I think longer term, somewhere between 2 and 3% is realistic. Obviously, that can be subject to change, as time goes on.
What's the next step?
Yeah, the second thing is just diversifying within those asset classes. So you've got your stocks now and you've got your bonds, making sure that you're diversified within those two asset classes. So looking at your large cap fund options, your large U.S. stocks, your small to mid U.S. stocks, your international stocks, and then maybe some emerging markets if you have those options.
Okay.
And then I think another thing that's really been brought to light this year is don't ignore the bond side. So if you're lending money for longer periods of time, those types of bond funds are going to be more subject to interest rate increases, which is what we're seeing this year.
Yep.
Longer duration bonds are what's being punished the most. And then also looking at the credit quality. So I think a lot of people are lured in oftentimes by bonds that are paying a higher yield, but oftentimes that means that they're less credit worthy. And so there's a higher risk that you may not even get your money back. So be a little bit skeptical of those. It doesn't mean that you don't want to put a portion of your bond allocation in those, but just be very skeptical of those.
Okay.
And then the last thing is just determining your risk and the expenses. So I'm getting a little technical here, but if you look at beta, you can click on your particular funds or ETFs or individual stock options, and beta is an indicator of risk. So if an investment option has a beta higher than 1, it means that it's riskier than the broader market. Less than 1, more conservative, right? And then looking at the expense associated with those investment products. Doesn't mean that if an investment product is more expensive that you don't want to use that one, but you just want to make sure that if you're paying a higher cost that you're getting that value back. And so I oftentimes recommend, doing a mix of maybe more active management and some passive management, passive being the more, the least expensive of the bunch, but it doesn't necessarily mean that something that hasn't worked well over the last 2 to 3 years isn't going to work well in the future. So again, asset allocation, diversify within asset classes, and then looking at the risk and expenses. I think those are the 3 steps to simplify this process. It's never simple.
I know, but that's great advice, and we appreciate you sharing it with our viewers, and we appreciate you being in studio today.
You're welcome. Thank you.
All right, we're going to take a quick break. We'll be right back after this.
The law provides